Hello, everyone, and thank you for joining us for today's presentation as part of the Industry Insight webinar series. The topic this time is how to survive a legal audit minefield. Speaking today will be Erica Bursler of CosmoLex and Pam Rosa of PWR Resources. The Industry Insight webinar series is hosted by the ABA Legal Technology Resource Center. To stay up to date on upcoming webinars or to view previous webinars, visit ambar.org/industryinsight. You can also stay updated on legal technology news and our webinars through our blog at www.lawtechnologytoday.org. Erica is the manager of customer success at CosmoLex. She has a Bachelor of Science in Business Administration and 5 years of experience in the legal software industry, catering to the specialized technology needs of small and mid-sized law firms. Erica has given numerous presentations on legal technology, such as law practice technology management, cloud computing, and legal billing and trust accounting compliance. Pam has worked in the legal industry for more than 25 years. She's the president of PWR Resources, a consulting company that assists law firms with a full range of services on the business side of the practice, including the customization of business accounting software to handle the unique fiscal requirements of law firms. Pam holds a master's degree in public administration from New York University and is a certified QuickBooks Pro Advisor and Xero certified consultant. Thank you all for joining us. We'll now begin the webinar.
Thank you, Josh, and welcome everyone. We have an exciting presentation lined up for you today, and one thing I can guarantee is that by the end of our time together, you will begin to look at your own law practice just a little bit differently. As you may well know, maintaining compliance is about your survival as a licensed attorney at law and about the survival of your firm as a successful law practice. Today I'm going to show you areas where legal practice management tends to get out of control and what you can do about it. Before we start, let's review some basics of law practice management. To manage your practice, law firms must have a legal practice management system. This is your matter management, your firm workflow tool. There are several fine choices depending upon your needs. Most on the market, whether legacy or cloud-based, can adequately handle your time and billing, calendar, tasks, and document management very well. Within the practice management system is commonly your legal billing system. If you don't use a practice management software, then time and billing can be done using the time and expense application or the old-fashioned manual log and invoicing the client. None of these options have a full chart of accounts to handle the accounting required for matter costs. That's where law firm accounting system comes in. Some firms handle this manually, and I include whether you use paper ledgers or an Excel spreadsheet. Or firms use a general purpose accounting software. This requires the customization to include the legal specific general ledger accounts, specialized reports, and a lot of user training to ensure proper entry. In my experience, these systems are not set up to handle the unique and intricate transactions required to maintain compliance. Having a foolproof system for the last two items is essential to surviving the legal audit minefield. Law firm accounting, please go back one slide. Law firm accounting has three components to it. Your business accounting, which is also known as back office accounting. It's the facility, the payroll, the paper, the computers. It's the everything else that's done, accounting-wise, that all businesses must handle. Back office accounting has nothing to do with the fiscal matter management that's unique to a law practice. Then there is matter cost accounting and time billing. Whether your firm handles hourly matters, flat fee matters, or contingency cases, or uses advanced client costs or reimbursable client costs, the accounting for these transactions is unique to law firms. Legal accounting also incorporates accounting for fee advances, retainers, and client escrow, which, as we know, is completely unique to law firms, with compliance regulations in place which are not optional. Handling all of these functions requires understanding compliance requirements and, at a minimum, a knowledge of accounting and good bookkeeping skills. In many law firms, the legal practice management system may include the billing component, but the accounting isn't part of this. The separation of the accounting software from the other two components results in a classical gap, where the person doing billing and practice management is on one side, and the person doing accounting is on another side. Each is working with his or her own part, but the sum of the parts cannot possibly equal the whole because they don't communicate with each other. This gap creates a minefield of potential improper, irregular, or incorrect postings. Navigating through the minefield, hitting any one of the mines, risks an audit that can ruin a firm. We will talk about 8 such audit flags today. Now, for purposes of the setup of today's webinar, I will first explain the issue, and then for demonstration of potential solutions, my co-presenter Erica will be using CosmoLex software. CosmoLex is a cloud-based legal practice management system specifically designed for small law firm needs. Commingling of client funds. We all love retainers. They really improve cash flow. However, every penny of advance fees needs to be tracked and kept current on a daily basis. Otherwise, this can become impossible to untangle for clients, for regulators, or for auditors. Mistakes on retainer handling are not only unacceptable, they are the primary cause for the majority of disciplinary actions against law firms. Client funds can consist of unearned fees, earned fees, cost advances, or settlement funds. Client funds will need to be deposited to either a trust account or an operating bank account. Today, we do not have time to go into how to determine where a retainer needs to be deposited. Each state has different rules and guidelines. Even then, procedures may vary from practice to practice within the same state. However, we can say that your accounting and billing system must be able to support the procedure that is correct for your situation. Remember, most disciplinary actions against law firms are related to retainer handling. It's essential to get this area set up correctly, kept current, and monitored closely. These are the types of commingling of funds that have become a problem. Your bank will only have one account where all client funds are residing. While there are some banks that provide sub-accounts within the primary trust account, most do not. To ensure compliance, your firm must have the bookkeeping resources to keep track of individual client funds. There are 3 types of commingling of funds. The client-to-client commingling. This is when different clients' funds get mixed up together and become indistinguishable. Client-to-law firm funds. This becomes more common when you deposit client advances in business or an operating bank account, as permitted by many states. Just because you are depositing advances in the bank account does not mean you have earned it. And clients' multiple matters. One client may have multiple matters. You need to track each matter as if it was a separate client. Erica will now demonstrate how this can be managed in your firm.
Thank you so much, Pam. As she mentioned, I'm going to go ahead and switch to the CosmoLex software. Regardless of whatever program you use, what's very important is to make sure that your balances are very clear at all times. I'm here right now on the matter page, and I have all of my matters listed here separately. And notice that my retainers, which are the 2 right columns, my operating retainer and my trust retainer, are very clearly outlined. I can see exactly what I have for each and every matter, and they're separated out. Also, any activity, including your trust activities, cannot be performed unless a matter is selected. If I try to do a trust retainer, it's telling me I have to select my matter first. So this absolutely prevents commingling, as I need to consciously select which matter this is regarding before I can go ahead and make a, let's say, a retainer or a transaction or whatever the case may be.
Thank you, Erica. Trust retainers are often recorded on an isolated trust ledger and are then drawn upon as needed for fees and expenses. Keeping track of these balances and drawing of funds is a manual task when you maintain separate systems. The risk of doing this is overdrafts, which is a significant audit flag even if the overdraft is accidental from a client ledger. This simply means you use someone else's money, and you cannot do that. Trust funds overdrafts will not be prevented by the bank. When the bank is presented with a check, they will clear it if there is a balance in the overall account. Please go back one. The bank only knows whether there is enough collected funds in the account, not in any one client's portion of that account. To make sure this doesn't happen, your firm must ensure the particular client has the funds in your books prior to making the disbursement. In this case, it is best to use an accounting system which can ensure a disbursement cannot be entered if it would result in an overdraft. Erica will demonstrate linked trust and operating transactions.
Okay, thank you so much, Pam. So again, let me switch back to demonstrate specifically the overdraft scenario. So in terms of overdrafts, like Pam said, when you have your overall bank account, your bank's aware of that. But if you're overdrafting on a ledger, they're not going to inform you of such things. So we already have here all of my ledgers reported individually. So I already know what each and every client has. But if I were to cut a check higher than the amount I have in trust, let's say, for instance, for this matter, if I wanted to go ahead and cut a check, let's say for $7,000, I only have about $5,000 available for this client. So if I were to go ahead and do so, it's going to prevent me and tell me that I'm going to have a negative balance, and I cannot go ahead and do that action. That's very important. Also, you want to be able to prevent the overdraft with invoice payment as well. So if I were to pull up a particular matter, just give me 1 second. Okay, and if I wanted to go ahead and, let's say, apply a payment to the invoice. Now I see for this particular matter, I have only $2,500 in trust, but I have a $2,800, even more than that, balance that needs to be paid. So if I were to pay this invoice, or let's say the invoices that I have from trust, okay, let's say I wanted to overdraft. I'm not paying attention. I'm going to say I want to pay all of these invoices, $2,884 as a check, and I'm going to pay all these off, right? Any other system would say, go right ahead, you have the money in the bank, but you're not supposed to overdraft on that ledger. So again, it's going to prevent you from doing so even on the invoice payment, which is debiting that trust account. The last point I want to mention is when you're dealing with your operating transactions. If I were to have a, let me go to my bank, I'm going to go to the operating bank, and I'm going to find a, let me just go back here, transaction that's linked to an invoice right here. This little symbol means it's been used to pay for an invoice. So if I were to go ahead and edit that, notice that I'm given a message, transactions linked to invoice payments. You can only edit the memo fields. You can't change the amount, you can't change any of the information because it's linked to an invoice. So again, it keeps consistency across the board with all of your types of transactions.
Thank you, Erica. You might have heard the term three-way reconciliation report. This is not some sort of wish list item. This is a mandatory report in almost all jurisdictions and is required to be produced monthly. Let me try to explain it simply. Your checkbook ending balance and bank ending balance, just like in your personal checking account, are normally different, as there may be uncleared checks as well as occasionally an uncleared deposit. This report ties three balances to ensure every penny is accounted for. Your checkbook balance, your adjusted bank balance, which accounts for checks or deposits which may be in transit, and the individual client ledger card balance. All three must match or else you have an issue. This is the first report you are likely to be asked to produce when you have a trust audit. Erica will show compliant trust reconciliation procedures.
Okay, thank you, Pam. So two things. Of course, you want to be able to handle your reconciliation in the first place and then generate the proper reports like Pam was mentioning. So the first thing is if I go to the report section and if I were to locate my reconciliation report, Okay, this is your overall summary for that particular account, okay, for that reconciliation. So this is going to give you your bank balance, your book balance, and a summary of your cleared and uncleared transactions. So in addition to, let me just, it's loading, give it one moment. In addition to your three-way reconciliation report, which I'll show in a moment, you also want to be able to show the regular reconciliation report. Hold on one second. I just want to make sure that this is opening up properly. All right. Okay, so here you have your regular bank reconciliation report, and I'll just zoom that in a little bit so that you can see. You have your bank balance, your book balance, and all the uncleared and clear transactions. And we'll get into a little more detail in one of the upcoming points that Pam's going to mention. The next report is the three-way reconciliation report. And like Pam said, this takes everything one step further. It's a three-way check. So you have your bank balance, your book balance, and all of those individual client ledgers. This is essential if you were to get audited. This is a type of report that they look for, and this is really the ultimate trust report. So again, I have my bank balance, I have my book balance, and I have all those individual client ledgers which are added up and equal that same total. So to do this type of thing manually, of course, would be very time consuming, but also error prone. So you want to make sure that you have some sort of tool to produce this kind of report every single month to have on hand.
Thank you, Erica. You may have thought all client funds are treated similarly on your general ledger. Actually, they're not. There are three types of general ledger accounts. Client trust funds, and these would be client settlement or fiduciary funds that the firm is holding on the balance sheet as a liability. These funds belong to the client and are to be dispersed on behalf of the client. The client general retainer, if it's a trust retainer, these are fee advances that are held at trust, and again, they are held in the liability account on the balance sheet. A client retainer in the operating account are also fee advances that are in operating if allowed, and are still a liability to the firm on the balance sheet. But a very common error and a significant audit flag is when the firm mistakenly posts fee advances in the operating account, but posts them as income before it is earned, meaning before there is work done that has been invoiced to the client and then paid. Not only is this not compliant with all regulations, it results in inflated income on your profit and loss, which will end up with tax consequence. Erica will demonstrate the different chart of accounts and the importance of proper posting to each.
Okay, thank you, Pam. And with that, we're going to specifically show you retainers. You want to, client funds in general or your retainers, they need to be posted to these proper accounts. And one of the things that are very unique to having a legal specific software is if I go here to the chart of accounts, we have legal specific accounts. You have your client trust funds, which is here. You also have your client general retainer, and you also have your general retainer for operating. So you have the three most necessary accounts for either funds or retainers. So it's very important to have those in place. Once they're there, whenever you do those types of activities, so let's say I were to receive a retainer, so I'm going to pick a matter here, and let's do a trust retainer. Notice that my account is already chosen, and I have no other flexibility here. I can't put it under an account you're not supposed to put it under. And like Pam mentioned, these are liability accounts, which is essential. Many people make that mistake of putting it under an income account, Retainers are not income until they're earned, which is through invoice payment. So you want to make sure that this is being done properly, and having a tool which forces this type of activity could be a big help.
Uncleared checks and deposits and uncollected funds. And thank you, Erica. This sounds simple, but this is a widespread issue, one which is easy to overlook, but it could become a big challenge down the road. Most service businesses do not lose sleep when their issued checks are not cleared. However, when it comes to your trust account, you retain a fiduciary responsibility until funds are cleared. And the longer it goes, the harder it becomes to dispose of that responsibility. Uncleared deposits or deposits in transit is a potentially serious violation. This happens when your accounting system has recorded the deposit on one day and the bank records it on a future date. The reconciliation between your books and the bank is a key factor. If too much time has elapsed, you are at risk of being penalized during an audit. So in other words, when you post the deposit in your system, you need to make the best effort and exercise due diligence to deposit the client funds to the bank when you receive them. For most banking transactions, uncollected funds only impact the user if there aren't enough collected funds to pay the check being presented to the bank. In trust accounting, the funds must be collected for the specific matter before issuing any payment on behalf of the client. The rules are very clear that the client funds must be segregated from each other. So, no, even if you have plenty of money in the trust account, even if you have collected funds associated with a different matter that won't close for another couple of weeks, even if you know the funds should clear in a day or two, you can't issue the check to the Register of Deeds or the mortgage company or the seller until the specific funds deposited for that matter have been collected by the bank. Erica will now demonstrate this process.
Okay, thank you, Pam. This one's fairly straightforward. We took a look at the reconciliation report before, and you're emphasizing the uncleared transactions. So here in this report is where you become aware of the uncleared items, those you want to keep track of month after month, because like she stated, you are responsible for those items until they are cleared from the bank.
Thank you, Erica. We've reviewed issues relating to handling client funds. Now let's look at what can create issues when handling accounting for matter-related activities. There are other businesses that bill customers for expenses. They can mark up or discount the expense. Law firms must handle matter costs in a prescribed manner, depending upon jurisdictional requirements. Advanced client costs is a balance sheet account. Expenses for contingency matters are booked in this account, and reimbursement is done at settlement. Some firms use advanced client costs for all matter expenses, even those that are contemporaneously billed and reimbursed. Because the activities are tracked on the balance sheet, profit and loss and cash flow reports are not impacted. Reimbursable clients costs is an expense account on the profit and loss statement. Typically, firms use this type of account for matter costs that are being invoiced to the client contemporaneously with the expectation that payments will be made in the short term. An example of an indirect or in-house cost is photocopying. The difference is that this cost is part of the firm's overhead or business expenses. Although the cost is associated with the matter so that the firm can be reimbursed, there is no distinct transaction that occurs when attributing the cost to the matter. No client cost general ledger account is impacted. Accurate posting is essential. Matter costs are actually loans to the client. Attorneys may not add a premium or markup to any cost. Erica will now demonstrate the different client cost accounts and how to properly post matter costs.
Okay. All right, so here one of the key things, like Pam described the differences between advanced client costs and reimbursable client costs, and that of course is your own accounting decision. But here you're able to set the defaults. So if I were to go to my settings, here I can select for what different matters go posted to what account, either reimbursable or advanced client costs. Once I set it here, it's a set it and forget it. I'll never have to worry about it in the future. And I'll show you what we mean by that. If I were to post an expense to a matter, so let me go to my operating account, and if I were to add a transaction, let's say it was $25 for a filing fee. Okay. What will happen here is you notice I get the option to post as a matter expense. Okay. When I'm going to select that option, and if I am to enter a particular matter, you'll notice right away that my account is now reduced to only one option, reimbursable client costs or a non-reimbursable, which is another option. You don't have any other account that you can allocate it to, so this forces the proper allocation. And we may speed up just a little bit because I notice we're getting a bit short on time.
I saw that. Thank you, Erica.
Mm-hmm.
Allocating the revenue a firm receives is dictated both by jurisdictional regulations and accounting practices. When the billing system and the accounting system are separate, even when the invoice is synced or a generic accounting software to a generic accounting software, the accounting system is not able to prioritize allocating the revenue. It will allocate the revenue equally across all invoiced items. This causes a myriad of accounting issues and audit flags. This is the priority in which your allocations must be met. The firm's liability must be paid first, so that would be things like sales tax, must be collected and paid prior to any other items being paid on the invoice. Then your assets, like advanced client costs, must be reimbursed, followed by expenses, and those are both the hard and soft reimbursable client costs. The firm may not recognize income, fees, passive income such as finance charges, or discounts to income until the other invoice items have been satisfied. The next slide provides several quick examples. And I'm going to ask Erica to now demonstrate.
Sure, absolutely. So here this chart just summarizes what your invoice will contain, how it gets posted, and how it should be allocated upon payment. So let me just show you that really quickly. If I were to pull up a particular invoice, for instance, I have one here. If I were to look at the details, you'll see that I have everything on here: costs, late fees, legal fees, discounts, everything under the sun. Normally in a general accounting software, when you receive the payment, you're going to have to go ahead and make those 5 or 6 allocations. Here, we always have everything's already set up in the back end in terms of what gets allocated where. So I just receive my invoice payment. It is now a paid invoice. And if I were to view that paid invoice, you're going to see here that not only you have the payment, but you also have the proper allocations as Pam lined up. Everything is separated out exactly as it should be, automatically.
Thank you, Erica. And just going back to that briefly, that is really very significant in partial payments, that you get the payments allocated correctly.
Correct.
Now, how well your firm is managing the previous 7 tasks, the previous 7 risks, the more comprehensive and accurate your reports will be. In most cases, an auditor will request certain reports, either in advance or when he or she arrives. The auditor is able to tell from the report whether data is incomplete, whether handling certain functions are compliant. If the reports are comprehensive and accurate, it's likely the auditor will ask for a sample of transactions to test and then be on their way. If the reports are not complete, if there are holes in the data, the auditor will likely demand more individual transactional data, as well as possibly look at your manual or electronic accounting system. In other words, auditors want reports. They expect those reports to have complete data and be readily available when requested. Here is a short list of commonly required reports, and Erica will now show you some in CosmoLex.
Yeah, considering we're a little short on time, really the main thing to point out is you need to be able to access these reports quickly and regularly. You saw when I generated the reconciliation reports, you need to be able to have them not only easily accessible, but be able to select whatever date range you want. If you need to go back 6 months or a year to print out a reconciliation report or ledger report, you need the flexibility to do so. As auditors, that is what they need. Reports first. Then if they see a red flag, then they need to go deeper. So you need to have especially these 8 reports on hand.
So I hope this presentation has given you a better appreciation of how state-of-the-art law firm accounting can keep your firm prepared so you survive audit minefields. It's about eliminating compliance worries, posting both costs and receipts correctly with each transaction, and protecting your practice from chaos and confusion. At the end of the day, it's about giving you the survivor skills to stay squeaky clean on a daily basis and be confident in your ability to navigate an audit should one arise. Well-designed systems now bring all these benefits within the reach and budget of any size law firm. Eric and I thank you for the time, and we'll turn the presentation back to Josh for any questions.